When a major crash wipes out the crypto market, it's easy to assume everything gets dragged down and eventually recovers as one massive, unified wave. But look closely at the aftermath. The market doesn't move together, it splinters. Individual assets fracture into wildly different structural patterns, separating the dead weight from the actual recoveries. To see this fracture in real time, we're taking a snapshot of 4 major assets right now: Shiba Inu, XRP, Solana, and Ethereum. By tracking these specific 4, we can map out a precise spectrum of reversal, a framework that separates a doomed relief bounce from a mathematically validated market recovery. We need 2 quantitative tools to map this spectrum: exponential moving averages, the 50-day and 100-day lines, and the relative strength index. Where an asset's price action sits in relation to these averages and momentum bands tells us its precise location. True trend reversals aren't driven by shifting sentiment on social media or a few random green daily candles. They are dictated by crossing absolute mathematical thresholds. We start at the far left of the spectrum. This is absolute structural weakness, and right now, Shiba Inu is the perfect case study. This chart shows SHIB's recent price action. Notice how it completely fails to maintain its macro trajectory, breaking down aggressively and falling right through the ascending channel that supported it from March through May. What traps the asset here is a specific mathematical ceiling. The 50-day EMA sits exactly at the 0.000045 level, physically capping those upward candlestick wicks and pressing the price down. The RSI sits in the mid-30s, showing momentum is incredibly weak, but it's not severely oversold enough yet to force a technical bounce. The mechanical consequence is clear. Sellers retain total control, opening a direct path for the price to drop into the crucial support zone around 4.1. For the bulls to even attempt a recovery from here, reclaiming that 50-day EMA ceiling is the bare minimum first step. This defines structural breakdown. The asset is trapped below all moving averages, meaning any minor upward push is completely irrelevant to the larger macro downtrend. Moving one step right on our spectrum, we find an asset locked in active technical conflict, XRP. This chart details XRP's recent trajectory. The bullish data point here is the asset's ability to print a consistent sequence of higher lows since the market bottom, forming a clear upward slope support line. But that upward support is fighting oppressive overhead resistance. The 50-day EMA at $1.12 and the 100-day EMA at $1.17 are pressing down heavily on the price, squeezing it into a tight compression wedge. The RSI has recovered above 40, confirming that underlying buyer momentum exists and is actively fighting back against those descending averages. This creates a psychological trap. Traders see the upward price action inside the wedge and mistake it for a true recovery, buying into a trend that hasn't actually flipped. To end the conflict, XRP must decisively break and hold above the $1.17 level. Until it clears that threshold, the asset remains trapped beneath major EMAs. Statistically, all that green momentum is just a relief bounce destined to fail. Shifting further to the right, we hit the exact inflection point where moving averages transition from overhead ceilings to supportive floors. We see this right now in Solana. SOL recently staged an aggressive recovery out of the $60 region, driven by a sheer influx of new buyer volume. Look at this crucial structural milestone on the chart. The candlesticks violently push upward through both the 20-day and 50-day moving averages at $75, and then begin resting directly on top of them. Mechanically, this action forces a shift. It physically flips the 50-day EMA from an oppressive ceiling into a dynamic support floor. It hasn't cleared everything yet. The rally currently faces rejection at its next immediate hurdle, the 100-day EMA near $81. Despite that rejection, the RSI remains comfortably above 50. Bulls maintain macro control over momentum. The asset is moving through a healthy consolidation phase. A fresh push above $81 will send it targeting the $90 zone. Flipping short-term EMAs into dynamic support is the mandatory technical validation you need. It proves a relief bounce has evolved into a genuine reversal structure. At the far right of the spectrum, we examine the final macro hurdle required for a full cycle transition, using the current market leader, Ethereum. ETH is displaying surprising relative strength compared to the rest of the market, rocketing from $1,500 straight back toward the $1,800 region. It has already completed all the required preliminary steps. It recovered its 20- and 50-day EMAs and aggressively defended buyer pullbacks. This chart shows the final gatekeeper preventing a macro breakout. Ethereum's price action is coiled tightly against a massive descending resistance trendline, intersecting between $1,780 and $1,800. The stakes at this exact threshold are absolute. This is the dividing line between market regimes. In the bullish scenario, a clean break above this trendline signals market-wide strength, instantly targeting the 100-day EMA at 1960. In the bearish scenario, a clear rejection right here throws Ethereum back down to test its $1,700 support floor. Testing and breaking a macro descending trendline is the ultimate final confirmation required. It is the definitive signal of a new bull market structure. Zooming out, we can see the entire spectrum mapped out. These four distinct assets mathematically illustrate the complete life cycle of a market. The transition from a bear market to a bull market is a sequential, mechanical process. It is not a sudden, random event. Step 1. The asset must first halt the bleeding and establish absolute support to avoid a structural breakdown, the SHIB rule. Step 2. It must begin printing higher lows to build underlying momentum, the XRP rule. Step 3. Buyers must generate enough force to push through short-term EMAs, flipping them from resistance ceilings into dynamic support floors, the SOL rule. And Step 4. The asset must break its macro descending trendline to definitively confirm the reversal, the ETH rule. Skipping any of these sequential steps almost guarantees that a rally is merely a trap. Technical analysis cannot predict the future, but it perfectly quantifies the present. It allows disciplined traders to strip away the noise, objectively look at the data, and know exactly where they stand on the spectrum of reversal.